Hello members, and welcome back to the macro webinar from Fat Profits. And my name is Roger Malik. As you know, I'm the host for your webinar today. And joining us today is fresh from a recent investor conference, our CEO, founder, and fund manager, Angus Geddes. Angus, welcome to the webinar. How are you today?
Hi, Roger. Very well, thank you. It's always good to be here with you on Friday doing the webinar.
Absolutely. So I know you've got a lot of insights from your recent conference. We'll get right into that, and we'd love to pick your brains on what you've heard from other similar like-minded people and fund managers, etc. So we'll get to that later on in the webinar. But firstly, let's do a bit of quick housekeeping. This presentation from Fat Profits is general in nature. We don't provide any personal advice. If you're looking for that, please see your financial advisor or planner, and also past performance is not an indicator of future performance. And as you know, this webinar is all about macro. It's all about the big picture, what's moving the markets. If you have any questions related to that, you can ask them during the presentation or towards the end of the webinar. Okay, so first what I'll do is I'll paint a bit of picture of where we have been last week. Let's start with last week first. Yes, over the last week, we've seen most markets go up, including FTSE, the Dow Jones, NASDAQ a little bit, but the ASX, unfortunately, has gone against the majority of the market, and we'll talk about that. Japan, just a little bit of cooling down, but still at a 30-year high as well. Now, before we talk about the future and our predictions, I have a quick snapshot of May, the month in review, just a quick look at what's happened around the world. So look, most major markets around the world were a little bit mixed, but the big story in May was AI, technology shares. They really led the gains, not just in the US, by the way, even in Australia, and you're going to see that in just a moment. Australian index has come down a little bit in May versus our global peers. And if you look at this snapshot here, you'll notice the S&P 500 in the US, the best and the worst shares across May. And I'm sure you already know these stats, but NVIDIA was the big story. AI, semiconductors, 36% jump in May alone, and they're now worth $1 trillion. Unbelievable. So that was really the big story across May, but you can see some other stocks as well. If you look at the sectors in the US market, of course, IT, tech really led the way, communication services, and then consumer discretionary as well. What was lagging was certainly energy and utilities. So energy continues to come down. Oil prices have come down, under a bit of pressure as well. Amongst the big stocks, well, you can see all the big names, the top 7 as they're called now, they all had a pretty solid month. Tesla has had a pretty good one as well. But this particular stat, I'm really fascinated by that, is out of the top 500 companies, 493, which is right at the bottom, the orange line, were only up by a combined 1%, but the top 7 combined 44% jump. And if you look at the S&P 500, up 10%. This is year to date, by the way. So this year so far, the S&P 500 is up 10%. But it's really the top 7 really propelling it. And that's what we talked about recently in market breadth. Before we move forward, Angus, just a quick, maybe, I know you look at all these things as well. Maybe if I can get a quick thought from you on this top 7 leading the benchmark.
Well, look, it's been a narrow rally. It's just a handful of stocks that account for 26, 27% of the S&P 500 have really led the rally this year. And look, we have seen a broadening of the rally with the bounce and the S&P, sorry, with the bounce and the Russell 2000 small mid-cap index. There has been a broadening of the rally this week, which is encouraging. But we're still a long way from there really being a convincing move higher in the US stock market. You know, a lot of stocks, most stocks, in fact, are trading well down from their highs, and many are actually in downtrends. So I think we've got to pay attention to that. Of course, you know, if the rest of the market begins to accelerate higher, and the rest of the companies that make up those indices, the S&P 500, start to move up, then, you know, I might change my view, but I'm still very cautious at the moment. And I guess the big development this week is the damage and the breakdown that we've seen in the bond market. Now,
Yes.
we've seen a number of bond markets break down where yields have moved higher. And in Australia, for example, you know, we saw the 10-year push well through 4% this week. You know, that's been the highest level that we've seen in over a decade. We've seen the US 10-year yield get to 3.8%, not far away from from the high point last year, the high watermark, when it got to 4.2, which coincided with the October lows. We've seen German bond yields break out as well. So, you know, this has been a really bad week for the bond market. And so, you know, I guess the message I really want to send today is I think it's quite serious, because the bond market, you seem to remember we've had quite a few chats about this, Roger.
Yes.
The bond market's actually been, or the futures market, I should say, has actually been pricing at rate cuts by the end of the year. So the way these bond yields are behaving, and the fact that they're going up, actually leans more into not rate cuts by the end of the year, but perhaps more rate hikes. And we saw the Bank of Canada raise rates again this week. We saw the RBA raise rates, and we'll find out what the Fed's going to do next week. But yeah, I think the bond market is definitely something to be concerned about. And I've written a lot about debt ceiling being raised, the fact that the US government are now going to have to borrow $1.2 trillion in the next 6 months. I mean, that is a lot of treasury bonds going to have to be issued to pay for that. So all of that supply is going to put upward pressure on bond yields. And of course, you know, the stock market doesn't really like high interest rates, and certainly not expensive growth stocks that are on multiples of 35, 40 times. You know, when you start seeing a US 10-year bond yield push above 4%, it's going to impact and eat into that valuation and put down pressure on long duration equities anyway. Yeah. So I am cautious. And, you know, typically in a new bull market, interest rates would be going down. That's typically a prerequisite. You know, the Fed would be cutting, and we're not seeing that yet.
Yes, absolutely.
So it's a flashing red light. And look, I could be quite wrong about the US stock market having a sell-off in the next quarter. I've certainly been wrong in the first half of this year. And you know, it is possible that the US could not have a recession, and it may be able to withstand this record pace of interest rate hikes. It is possible, in which case, you know, we'll probably see the rest of the stock market in the US start breaking away to the upside. But you know, given this breakout move in the US 10-year, if we see those 10-year yields go up much further, it's going to be a huge headwind for the stock market. The other point I'd just like to make really about this week is, you know, in Australia, the stock market price action has been quite poor. You know, we saw the ASX 200 come off to 7,100 or thereabouts. And I think, you know, that's quite telling as well, because and I think that's probably a reaction to, you know, what we saw with the RBA raising rates. You know, at some point, Australia is going to react. The economy is going to react to this pace of tightening, and we know that the Australian economy is quite sensitive to interest rates because of the housing market, and what that's been doing over the last sort of 3 to 5 years. So I think, time for some caution at the moment.
Yeah, Absolutely, and we'll definitely touch on some more key points in just a moment as well. All right, moving forward, if you look at the ASX best and worst sectors for last month, the IT certainly led the way as well. So the financials and consumer discretionary are, softening, as you can see across board. And if you look at the best and worst stocks, you'll see a couple of lithium stocks in there as well, including Allcam, which is in our portfolio, and they're now merging with another company. Now let's move on to the big news of this week. And the big news this week is two reserve banks around the world, which is Canada and Australia. They have raised rates. Well, Canada in particular was very surprising to the market because they had paused for 4 months. The last rate hike was in January. So they have paused, and now suddenly they've gone back up. So that took the market by surprise. And part of the reason is on the right-hand side, which is the inflation, which was coming down, but it's suddenly seen an uptick, which they don't like. It's now back up to 4.4%. And we know the target for the central banks around the world is 2%. So in order to bring that down, they decided to tighten that further. Moving on to Australia, we know that the big story this week was another rate hike, 0.25%. The market was divided leading into Tuesday, 50-50 call. They've gone with that, and now the expectation seems to be there might be some more rises. And I know you attended the recent speech as well, Angus, but we'll just, before we get to your thoughts, and I know you've got some strong views on this, I'll just paint the picture a little bit further, that inflation in Australia, and part of the reason they've raised rates is very similar to Canada, is the inflation has gone back up, as you can clearly see on this chart. It was coming down, but it's now ticked back up, and nobody wants that to happen. And you can see that on a slightly different chart here. It's gone up to 6.8%, which is unwelcome. And if you look at the reaction from the rate hikes, well, we saw the 2-year bond yields go up post the rate hike. We've seen now the expectations that the interest rates will rise further is right here in front of you. The expectation is there'll be at least one more rate hike, and they're now starting to price maybe a slowdown around December or next year. So Angus, over to you. You've listened to the speech, you've attended the conference. Please tell us your views and thoughts on what the RBA is looking at the moment.
Well, I think, the one message that Dr. Lowe really emphasised in his speech this week, which I attended, is that the RBA is totally committed to bringing inflation down. And so we can expect, the RBA to hold the line and keep rates high for quite some time until the inflation is absolutely squeezed out of the economy. He was very emphatic about that. But the other key takeaways were that he's quite comfortable with the 2-year path, like a 2 to 3 year path in terms of a glide to bring inflation down. He's not trying to do it. The RBA is not trying to get rid of inflation today or tomorrow. They're prepared to tolerate a higher rate of inflation as long as it's coming down and inflation expectations are coming down. He was concerned about the path that they are on. He thinks it's narrow and that there are risks on both sides. Some of the things that he's worried about was the recent strength in the housing market and what that meant for inflation and rents. He was also concerned about the award increase and the increase to the minimum wage. He was surprised at how big that was, and he's worried that 65% of Australia's working population take a lead from that award wage. So he just said that provided it doesn't lead to a breakout in wage growth, inflation should start to come down. He also said that he thinks that Australia is a lucky country. It is a lucky country. He talked up the economic prospects and said that over the medium to longer term, we've got a lot to be excited about, and grateful for. He said that the economy's strong. We've got a low amount of public debt or government debt relative to GDP, one of the lowest in the Western world. You know, we've got the commodities as a tailwind. You know, it's a big driver, big buffer to the Australian economy. We've also got a high amount of immigration, which is going to keep the economy growing over the medium to longer term. But he did acknowledge, you know, that times are pretty tough for a lot of Australians at the moment, and that, you know, it is a painful part of the cycle that we're now going through. But he just emphasised that, you know, it's about taking the pain now rather than taking a lot more pain down the track if they will let inflation get out of control.
Yes, all those points are absolutely valid. So look, it will be a tough period, no doubt about that, for a lot of households. We have to weather the storm, but if the rates rise one more time or maybe twice, who knows? But yeah, we have to be prepared for it. But look, the Australian dollar, after the Reserve Bank decision, of course, has now gone back up. It's over 67 cents. So we know what happens when rates rise in a country, the local currency does go up. So we've seen that. But the other point is made, as you can see on your screen, is as Angus also just mentioned as well, that some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame. And we can clearly see the household spending is slowing down, and you can see that in the front of you as well. February, March, April, across all spectrums, has continued to slow down, and we can probably expect that to continue in the next 6 months and beyond, which will hopefully bring the inflation down quick enough for us not to get into too much trouble. Finally, before we move back to the US, Angus, quick look at the ASX 200. Yeah, we've come down versus the US in the last month. US has gone up in some of the other markets like FTSE, but ASX has come down a little bit. What are your thoughts on the short-term expectation in the Australian index?
Well, I'm still, you know, cautious, Roger. You know, I think that the RBA lifted rates this week, but I don't think that's going to be enough in terms of I don't think it's enough to sufficiently slow the economy down to squeeze inflation out of the system. I think they're going to have to go higher, possibly to a terminal rate of between 4.6 and 4.8%. You know, so with the cash rate at just a bit over 4, there's actually probably a bit more tightening to go. And, you know, as we've seen with the economy, it is sensitive to interest rates, particularly mortgage borrowers, which, you know, on average are, you know, allocating, you know, 30% of their disposable incomes to servicing their debt in many cases. And, you know, we know that the RBA will be paying close attention to mortgage delinquencies, loans that fall over. But, you know, my fear is that Australia is now walking a very narrow path where we tip over into recession because the RBA is forced to tighten rates too much. And my concern is that, you know, the average Australian is doing it very tough at the moment. It's hard to make ends meet. You know, we've seen the inflation push up the cost of a lot of goods and services and rents, etc. You know, and that's eating into disposable income. So, you know, I think there's a good chance that the economy could stumble at some point, and you know, in which case there's downside earnings risk. There's downside risks to earnings, and I think that, you know, so near term I'm cautious. But, you know, as I keep emphasising, I don't think the ASX 200's got much more downside than that sort of 68, 6,600 level. And, you know, we've got priced on a much lower earnings multiple than the US market. So, relatively speaking, there's less valuation risk here. But as I said before, you know, we have got earnings risk, and, you know, I'd still advocate carrying, you know, a decent amount of cash in your investment portfolio.
Yeah. Okay. That's pretty clear, and I agree with you. I think we are going to see. I mean, if anyone believes that we're out of the woods and off to the races, I think they need to do a little bit more reading. But yeah, I think most people agree that there is more headwinds around the corner. Moving on to the US now. Well, one of the key things now on the calendar is next week. We've got the Federal Reserve meeting on Wednesday, and we'll find out if they decide to pause or raise rates again. But part of their decision making would be the inflation CPI number, which comes out on Tuesday, a day before the meeting. So maybe that might influence them somewhat. But the expectation now seems to be that there will be a pause, and there's a likelihood of that happening. And part of that is overnight, we've seen the US jobless claims, which have gone up. And you can see the 1-year trend. It is starting to slowly but surely get in there. But last night was the biggest jump. Over 261,000 people claimed for jobless claims. So that was a sizable jump. So that's probably going to feed into a pause from the Federal Reserve. But the other thing they've looked at recently is the PCE index, which is the personal consumption index, which is the preferred measure of inflation. That has also gone up. So it's not an easy job for them. And looking back at a bit of a longer term trend of the PCE index, which excludes food and energy, which is what they like to look at. Look, it has come down recently, as you can see, but it's still quite elevated according to historic levels. And the last time it was as high was before 1990. So they don't want to see this, and they certainly want to bring this down. So Angus, your thoughts on the Fed next week, and what are your expectations? A pause or another hike?
Oh, look, it's hard to say whether they're going to do another 25 basis points at the meeting next week. I mean, the futures markets are giving it a 50-50 probability, but I've got more conviction that they're not done yet on the tightening front and that there's more to go. So if they skip next month, they'll be back in July with another 25-point rate hike if inflation hasn't come off markedly. And yeah, so that's for my view there. I think the Fed has been surprised at how sticky inflation is actually proven to be in the US. It's been hard to bring it down. Meanwhile, the US economy hasn't, it's still remaining very resilient, particularly on the labour market front. We've seen the economy slow down, but it hasn't rolled over. We've seen the S&P 500 get back to within 12% of its record high. So, my view is that they will remain very much committed to keeping rates high until that inflation rate really gets back down towards target.
Yeah, absolutely. So commenting on the S&P 500, I know you pointed that out today, and you've been talking about in the recent weeks that, once they grow past 4,200, the short-term trend will most likely continue for a while. Now we're close to 4,300. There's been talks about, now the S&P entering a new bull market because they're up 20% off the October lows, which we can see right there. So technically, it's now a new bull market for the S&P 500. What are your thoughts there on the market trends?
Look, as I've sort of been saying for a while, this technical chart, the technical setup for the S&P 500 is really, that's a bullish pattern, and which is one reason why we took our short hedging off last month, and with the view that the market was going to break out above that, what was potentially going to break out above that 4,200 level, and that rally, and we've indeed seen that. It's sitting just below 4,300. Could it go higher? Yes, it could. We've seen a lot of FOMO buying, fear of missing out, cash and liquidity coming in from the sidelines. We've seen a lot of short covering and a lot of hedging taken off in the last week, and that could go on for another couple of weeks, and we could see the index even higher. But I think, as we move into the June quarter, I think more companies are going to be cautious about the outlook. There's no question that those interest rates are beginning to bite. And of course, I don't like the damage that's been done in the bond market. This breakout in bond yields is very concerning. And we might have a chart of, I think you've included some of those bond yield charts, which we can go through.
Yes.
So I think that is concerning. And of course, we've got 1.2 trillion of issuance combined with from US government. They're going to sell 1.2 trillion of bonds to pay for to replenish the coffers after lifting the debt ceiling. Plus, we've got what else? So like all of that's going to have a put upward pressure on those bond yields. And
sure.
Equities just don't like bond yields that are going up.
Okay.
And I think at some point that's going to create a decent shakeout in the US and potentially in the global stock markets as well.
Yes. So look, that's a good point. I think before we get into the bond yields, one of the questions come from Alan. Hi Angus, great webinar, thank you. He said the fact that media are now reporting that a bull market is now underway in the S&P, and the fact that the average investor does not understand bond markets like you do, won't investor sentiment simply continue to push the markets upward and be unaware of the true fundamentals? And I think you've partly answered that question, but
yeah, I mean, it doesn't feel like a bull market. Normally in a bull market, after a bear market ends, you've got the Fed cutting rates, interest rates going down, bond yields going down, the economy slowing, unemployment bottoming out and going down, and the labour participation rate going up. We're not seeing any of those things. None of those conditions are in place. What we have seen, of course, is the S&P 500, which looks bullish on this chart, run away to the top side, but it's just been driven really by a handful of stocks. Yes, we've seen the Russell 2000 take off this week, it lifted 5 or 6%. That seemed to me really more about investor positioning for those that had sort of missed the rally in the first half of the year. And if we look at the Russell 2000 technically, it's still got a very, very bearish, negative technical setup. So, time for caution. I'm just not really a believer in what's going on. I could be completely wrong, and I might be forced to change my view. But I've never seen a stock market, go into a new bull market when the bond market's been damaged and sold off in the way that it has. And if those yields, those US 10-year yields, break out on the top side and run away and challenge the October highs at say 4.2, I don't think the stock market will take that very well.
Yeah, well, that's a key point. I think the bond market is something to keep an eye on. And you're right, well, technically it's looked like we're at an inflection point, and I guess next week's meeting might give us some clues. But looking at not just the US bond yields, but even Australian 10-year bond yields have risen with rising rates, of course. And you can see the setup from today's daily fact chat that you pointed out. You can also look at the German bond yields as well. They're starting to also move higher. So this is pretty much a reflection of what we're anticipating at the moment is higher rates for longer.
Yeah. I mean, if we look at these charts, I mean, you've got the big end of the secular bull market in bonds with that big breakout in 2021, 2022. We've seen the Australian bond yield hit 4% or just over 4%. I think it was 4.2% it got to last year in October. It's had a big consolidation since then over the last 9 months or so, and now we're seeing the Aussie 10-year yield reassert to the top side. So this is a bullish, a bearish setup for bonds with interest rates looking like they're going to break out above 4.2, 4.3% in Australia.
Okay. All right, let's move on to, I think one of the key points, just to highlight as well, you mentioned about earnings. Just before we talk about China now, because I think US is pretty clear for us, is earnings. And something which a lot of the market is now positioned for good earnings going forward, especially with AI now really propelling the estimates for the future. But this particular chart is quite interesting because this shows the earnings upgrades for the first time in the longest time, which is the blue line, by the way, just for clarity. That's front running the economic data. The black line is the leading economic indicators, and you can see that hasn't happened for a very long time, where the earnings forecasts are now rising, where the leading economic indicators are still falling. And you can pretty much see all the time in the past, they go up and down in tandem, but there is a big divergence happening. So the earnings are really front running the leading economic indicators for the first time in a very, very long time. And that usually doesn't happen. So if the earnings have to be absolutely perfect in the next 6 months for the market to continue this trend, otherwise we will see a revision to the downside. So that's what we're looking at.
Just to add to that, Rog,
Sure.
You know, the bond market takes its lead from the Federal Reserve and is guided by the Federal Reserve. The stock market takes its lead from company management and what those managements tell Wall Street and what those analysts go out and model the earnings and base their forecasts on. You know, the key variable that goes into those models is what the managements are telling them. Sometimes this relationship can be wrong. Just as the bond market got it so wrong listening to the Federal Reserve in 2021 with the view that there wasn't going to be any tightening, that inflation was transitory, that 50 basis points of rate hikes would do the job. And of course that was wrong. That signaling from the Fed was completely wrong. So the bond market was wrong, and we saw that that big secular breakdown in that bull market in bonds. It was over. It finished in 2021. So the stock market it does rely on earnings forecasts. There's been a lot of upgrading going on, but if you believe it, then the stock market is priced correctly today. But if you don't believe it, and you think companies are going to be struggling in 6 months, and that the US economy is going to materially slow down, and that there's going to be an earnings recession, then the stock market is not pricing it correctly at the moment. So yeah, I just wanted to add to that point, like earnings upgrades. And
well, that's a good point. In fact, that's what its share market is all about, is company earnings, and that's what's driving the current optimism. So just to finish off on today, just talk about China as well, because that's really important to Australia in particular. But we know the slowdown in China has now gone on for a few months, and this particular stat is the exports in China. Just a couple of days ago, they've dropped 7.5%. So that was quite a sizable drop compared to expectations. And now the other thing, which is this might be quite interesting for people to look at as well, this is the Chinese 10-year bond yields, which is the black line at the bottom, versus the US manufacturing, which is the orange line. And again, you can see they pretty much go in tandem all the time. So Chinese exports are very important in the US as well. So as the Chinese 10-year bond market is pretty much signaling that the manufacturing is also slowing down. So they're pretty much telling us a bit of a picture of what is happening behind the scenes. But Angus, this is the second biggest economy in the world slowing down. Now there's new speculation that there is a good chance that the government steps in and provides a stimulus package to revive the economy. There's a pretty good chance that they'll probably do that. What are your thoughts on China currently?
Look, I think they are going to come in with a big stimulus package. I think they're going to do it because they have to. The economy and the economic reopening has been fairly tepid. A lot of economists were a lot more optimistic six months ago, and so we can expect more stimulus. But I also think this probably points to the legacy and the hangover from the bursting of the property market and the damage that's been done. It's taking a while for the Chinese consumer to really shake that off. So this doesn't mean to say that we haven't seen I think we have seen the lows in the Chinese equity bear market, but clearly the economy is probably not quite where it needs to be. It's not on that back on that on a smooth growth trajectory, and there are clearly issues. And of course, things could get harder for the Chinese economy if the rest of the world slows down or goes into a recession.
Yeah, absolutely. So it's something we will look at what happens over the coming weeks, but that's important to the iron ore and the mining market for sure. All right. Well, finally, Angus, we know that you recently attended the conference as well. Any thoughts on, Morgan Stanley, I think it was. Any thoughts on what you are hearing, what you've, any takeaways that you can pass on to us as investors and all our member base?
Look, I thought it was really interesting listening to John Gray. He was the Chief Operating Officer at Blackstone, the world's largest fund manager. They've got $1 trillion under management, and it was fascinating listening to what he had to say. He singled out Canada, Australia, and the UK as being property markets. They thought that had, particularly Australia, had a big tailwind, and the economy from immigration, over the next 5 to 10 years. He also felt the same, and with the commodities as a backdrop to the economy, and he felt in a similar way to Canada. So yeah, he was quite upbeat. I think the other takeaway was listening to Jared Minak, and he used to be one of the top strategists at Morgan Stanley. He's now got his own advisory firm, and he looks after institutional clients. And Gerard gave a fascinating presentation, very similar outlook on the bond market to me. He said that he thinks bond yields are going up a lot higher. His view was that Australia and the United States will be in recession, hard landing recession, in 6 months. And he made the point that consumer savings are tapped out. That disposable incomes have been knocked around, and inflation's lowered the increased cost of living for a lot of people, and that's going to have a profound effect on the economy in 6 to 12 months' time. The over-earning of companies during the post-pandemic era is over, and there's going to be a payback in demand. But so I thought that was interesting, and he thinks that bond yields are going a lot higher, and they are now in a secular bear market. He made the point about treasury bond issuance and how much debt the US government's is going to have to issue, and he was pretty bearish. Mind you, he is a permanent bear. Roger is a permanent bear, and as we say, bears have no shares. But I thought that was interesting, and I like listening to Mike Wilson. He sort of doubled down on his view, and he just said that we've never been this far apart from Wall Street in terms of where we think earnings are going in terms of our leading indicator models.
Yes, you're right. Yeah, Morgan Stanley's got a very different view than the rest of the Wall Street. You're right. All right, thanks, Angus. Look, a couple of questions to round off today. It's been quite interesting listening to you. First question from Kev saying, hi, Angus, are you still bullish on gold? And also, do you have a view on coal over the short and long term?
Look, I think on gold, it's correcting at the moment, and it's correcting in the face of US dollar strength. So the US dollar has been edging higher. As it's gone higher, commodities have corrected, and gold's been sort of caught up in that. I don't know exactly when the correction is going to end, and we could see, another sort of $50 to $75 of downside in the gold price before the correction's over. But I've got high conviction that over the medium to longer term, it's going to be a lot higher than where it is at the moment. And I think that any strength that we're seeing now in the US dollar, which is being driven by the US Fed raising interest rates and rising interest rate differentials with the rest of the world, I can see that gap closing in the next 3 to 6 months, and that will take some of the heat out of the US dollar. And I think, you know, given the amount of debt that the US government is going to be borrowing and all those treasury bonds that they're going to be issuing, you know, I don't think that's going to be good for the greenback. And I don't think, you know, with rising interest rates over there, I think there is a material risk that the US goes into recession. So, you know, in which case we would then see the US dollar start to come off. And I think that will be when gold reasserts to the top side. Having said that, I still really like the gold producers. I still think they are quite cheaply valued. You know, in Australia, you can buy, you know, gold producers that are making great free cash flow and profits, similar to what the, you know, with the Australian dollar spot gold price at 3,000 an ounce, similar to what the coal producers were doing last year. And, you know, the market's not rewarding that. So, you know, I think there's still a lot of value within that sector. So I'm quite happy to stay there for the time being. In terms of coal, look, I think, you know, coal, we got out of all our coal stocks a while ago, so no longer there. You know, it is dirty fuel, but look, the world is not going to be able to switch over to a green economy and alternative energy sources tomorrow. It's going to be a big transition. So it's hard to see the coal price collapsing and falling back to $50 a tonne. I think it's going to be elevated for some time. There's less of it around the world being mined these days. There's no new capacity. So, you know, for now, those coal stocks are still in the sweet spot where they're generating lots of cash.
All right, good to know. And look, the last question for today is from Rob regarding today's Fat Chat, where you mentioned the bellwether staple Campbell Soup's technical breakdown this week, sending a pretty compelling message. Could you expand on that, Angus?
Yeah, so I think, look, Campbell's Soup is a staple. You know, it's a staple food producer. And, you know, it's a staple. It's consumed by, you know, households, not just in America, but all over the world, really. And what we saw this week was quite a marked drop in the share price based on lower earnings expectations and lower guidance from the company. And, you know, I think that really goes to show just how tough the consumer is doing it at the moment. There's just less disposable income to spend on, you know, even things like staples like Campbell's Soup. So it's a pretty telling indicator. And it's not just Campbell's Soup. You know, we've also seen it with LVMH and the luxury goods owner. You know, they've owned all the brands like, you know, Gucci and you know, a number of luxury brands, and they've also lower guidance. So, you know, it's what we're seeing is the consumer at the top of the food chain. You know, in terms of luxury good spenders, they are also feeling the pinch and having to tighten their belt. So, you know, I mean, this is all to be expected at this stage of the cycle, and that's, you know, one of the reasons, Rog, that I'm still cautious. I don't think the bear market is finished yet. We haven't seen the market throw the towel in yet on earnings, and I think earnings guidance is going to go, and earnings are going to go down. I think there's downside risk as the consumer tightens their belt. So that's pretty much what I was sort of referencing in relation to Campbell's Soup.
Excellent. All right, that's very clear. Thank you, Angus. I'm on the same page as you, and I do believe, you know, of course, as all investors, we all want this bear market to be over. We all want, you know, good sunny days ahead, of course, and we want our portfolios to just start moving up in the right direction. But, you know, there's time between now and the end of the bear market, in our opinion. Of course, once that is over, we will be making that call and starting to put that cash back in the market. Of course, can't wait for that time, but unfortunately we have to. Patience will be rewarded. So on that note, look, it's been a pleasure having you today, Angus. Thank you for your insights. And we'll continue to follow your direction, and we look forward to chatting with you again on Thursday. Thank you, members, for your questions and participation. My name is Roger, and we look forward to your company again next week. In the meantime, I'll pass it on to you, Angus, for your final words.
Oh, thanks, Roger, and thanks everyone listening today. Roger and I will be doing a webinar next week. Can I mention this now, Roger? It's not going to be live.
Yeah, sure.
Only for 3 weeks, whilst I'm going to be working remotely up in Europe, and we'll still be doing the webinar, but because of the time differences, it's just going to be too tricky to do it at the usual time live at 12 o'clock. So we're going to do a pre-record and that morning, and then the webinar will be posted at 12 o'clock on Thursdays at the usual time.
Perfect. All right. Bye for now. Thank you.